The United States owes $37 trillion, more than any nation in history, more than the entire global economy produced in 2003. And they're not planning to pay it back. They're planning to erase it, not through default, not through austerity, but through invisible devaluation. The mechanism? Crypto and gold. You're watching the most sophisticated debt elimination strategy ever attempted. They're building parallel infrastructure, tokenized treasuries, digital dollars, gold-backed settlement rails, preparing to revalue strategic reserves at multiples of current prices. When they revalue gold and Bitcoin upward, they devalue the dollar downward. Every savings account evaporates in real terms. Every bond becomes worthless. This isn't theory, it's already happening. Executive orders signed. Bitcoin reserves accumulating. Gold purchases undisclosed. The timeline isn't decades away. The infrastructure deployed in 2025. The reset began before anyone noticed. And most people won't realize they've been robbed until their purchasing power is gone. The economy looked unstoppable. The S&P 500 had closed January 2025 at all-time highs. Tech stocks surged on AI optimism, and unemployment held near 4%. CNBC anchors celebrated the resilience. Earnings reports beat expectations. Consumer spending remained robust through the holiday season. The narrative was clear. America had engineered a soft landing, defying recession predictions that had dominated 2023 and 2024. But underneath the celebration, the debt curve had steepened at a pace not seen since World War II mobilization. Federal debt reached $37.2 trillion by February 2025, breaching 124% of GDP, a threshold that historically marked the point where growth becomes mathematically impossible to sustain. The contradiction was violent. Markets priced in perpetual expansion while the government's balance sheet screamed insolvency. What made this moment worse than 1929 or 2008 was the simultaneity. In 1929, debt levels were manageable when valuations peaked. In 2008, valuations had corrected before the sovereign debt crisis emerged in Europe. But in 2025, both variables hit extremes together. The Buffett indicator, total market capitalization divided by GDP, exploded past 210%, surpassing the dot-com bubble's 153% peak and dwarfing 2008's 110%. Meanwhile, the debt-to-GDP ratio exceeded any peacetime level in U.S. history. Insider selling data revealed what executives actually believed. In Q4 2024, corporate insiders sold shares at a ratio of 4.7 to 1 against purchases, the highest since Q1 2008. Billionaires weren't buying the rally, they were executing the exit. Jeff Bezos sold $8.5 billion in Amazon shares. Mark Zuckerberg liquidated $1.3 billion in Metastock. Jamie Dimon reduced his JP Morgan position for the first time in years. The pattern was clear. Those with the best information were leaving. The system was already cracking. The mechanics were simple. Every previous bubble shared this structure. Asset prices rise faster than economic output, creating valuation extremes that require perpetual liquidity to sustain. When liquidity contracts, through Fed tightening, credit stress, or foreign capital flight, the structure collapses. The math doesn't negotiate. Markets gloated about corporate profitability. The S&P 500's forward PE ratio sat at 22, above the historical average, but seemingly justified by low unemployment and solid earnings growth. Analysts published optimistic 2025 targets. Retail investors piled into index funds, believing the rally had years to run. The financial media celebrated American exceptionalism. But the Buffett indicator told a different story. At 210% of GDP, total market capitalization had reached a level that Warren Buffett himself called playing with fire. The metric had predicted both the 2000 crash, when it peaked at 153%, and signaled danger before 2008, when it reached 110%. Now it stood 40% higher than the dot-com extreme, with none of the productivity growth that had even partially justified late 1990s valuations. Corporate leverage compounded the danger. Non-financial corporate debt reached 82% of GDP by early 2025, the highest ratio in American history. This surpassed the 2008 peak of 70% and dwarfed the 1929 level of 45%. The debt wasn't financing productive expansion, It was funding buybacks, dividends, and financial engineering. Corporations had borrowed trillions at low rates between 2010 and 2021 and now faced refinancing cliffs with interest rates triple the original borrowing costs. The divergence between market behavior and structural fundamentals was worse than any previous bubble. In 2000, at least the internet represented genuine technological transformation, even if valuations were delusional. In 2007, real estate had tangible assets behind the leverage. But in 2025, the rally rested purely on liquidity, on the belief that the Federal Reserve would never allow asset prices to fall, that deficits didn't matter, that debt could grow forever without consequence. This wasn't speculation. It was mathematics. Foreign holders began reducing Treasury positions in late 2024. China's holdings dropped to $780 billion, the lowest since 2009. Japan trimmed reserves for 3 consecutive quarters. Saudi Arabia shifted $40 billion into gold. The world's central banks were quietly preparing for dollar instability, even as American investors bought every dip. Consumer sentiment surveys showed confidence near 15-year highs through January 2025. Americans believed the economy was strong, unemployment would stay low, and their home values would keep rising. Retail spending remained robust. Credit card usage surged. The University of Michigan's Consumer Sentiment Index climbed above 80, signaling optimism not seen since before the pandemic. But credit card debt crossed $1.13 trillion in Q4 2024, with delinquencies rising 26% year over year. This was worse than the 2007 subprime peak, when delinquencies rose 18% before the housing collapse. The average interest rate on credit card balances hit 22.8%, double the 2008 rate, while minimum payment requirements consumed larger shares of household income. Auto loan delinquencies climbed to 7.9%, the highest since 2010. Student loan repayment resumption after the pandemic pause was crushing millions of borrowers. The contradiction was stark. Consumers felt optimistic while drowning in debt at interest rates they couldn't afford. The divergence mirrored 2006 to 2007, when homeowners believed rising home prices would bail out unaffordable mortgages. It mirrored 1929, when margin debt funded stock purchases that individuals assumed would always appreciate. Confidence masking structural decay, the signature of every pre-collapse period. Federal Reserve minutes from December 2024 contained a warning buried in technical language. Sustained imbalances in household leverage relative to income growth may trigger nonlinear adjustment dynamics in consumer spending. Translation: the debt load was unsustainable, and when it broke, the contraction would be sudden and severe. Commercial real estate compounded household stress. Office vacancy rates in major cities exceeded 25%, the highest since the 1990s savings and loan crisis. Property valuations had declined 40% from 2022 peaks, but banks hadn't marked the losses to market. Regional banks held $1.7 trillion in commercial real estate loans, with $900 billion maturing between 2025 and 2027. Refinancing was impossible at current rates. Most properties couldn't generate enough cash flow to service debt at 8% interest. The numbers were worse than 1929. Underneath the optimism, the floor was already collapsing. The United States crossed $37 trillion in federal debt in February 2025. Interest payments reached $1.2 trillion annually, surpassing defense spending for the first time in American history. This milestone marked a structural turning point. Debt service had become the government's largest expenditure, crowding out everything else. The comparison to past crises revealed the danger. During the 1970s stagflation, debt to GDP peaked at 35%. During the 2008 financial crisis, it reached 67%. Now it stood at 124% and accelerating. The Congressional Budget Office projected $2.4 trillion annual deficits through 2030, even under optimistic growth assumptions. But the real trajectory was worse. Every percentage point increase in interest rates added $370 billion to annual debt service costs. The speed of accumulation was unprecedented. The U.S. had added $1 trillion in debt every 100 days since mid-2024. At this pace, debt would reach $50 trillion by 2028, pushing the ratio above 140% of GDP, a level that no major economy has sustained without currency crisis, default, or hyperinflation. Greece collapsed at 180%. Japan survived higher ratios only because it owned its own debt and maintained trade surpluses. America had neither advantage. Worse than 1970s stagflation. Worse than 2008. Worse than 1929. The mathematics were straightforward. When interest rates exceed GDP growth, debt spirals automatically. In 2025, the 10-year Treasury yield averaged 4.8%, while nominal GDP growth ran at 4.1%. The gap was narrow, but pointed in the fatal direction, debt compounding faster than the economy's ability to service it. Every future projection assumed this would reverse, that growth would accelerate or rates would fall. But structural conditions guaranteed neither. The debt clock had become a countdown. Foreign creditors' behavior confirmed the danger. International holdings of U.S. Treasuries declined for 4 consecutive quarters through Q4 2024, the longest streak since 2015. China reduced holdings to 15-year lows. Japan's purchases slowed despite its role as America's largest foreign creditor. The Gulf states shifted reserves toward gold and European bonds. The world was losing faith in U.S. fiscal sustainability, even if markets hadn't priced in the risk yet. Repo markets flashed warning signals in March 2025. Overnight borrowing rates spiked 40 basis points in a single session, an unusual move that recalled September 2019, when repo rates briefly hit 10% and forced emergency Fed intervention. The spike revealed what few wanted to acknowledge. Liquidity was tightening faster than official metrics suggested. Bid-ask spreads on Treasury securities widened to levels not seen since the March 2020 COVID panic. The spread on 10-year notes doubled from 1.5 basis points to 3 basis points, a seemingly small change that signaled deteriorating market depth. When spreads widen, it means dealers are demanding higher compensation for holding inventory, which means they expect volatility or believe they'll struggle to offload bonds. Either interpretation was dangerous. Primary dealers, the banks required to participate in Treasury auctions, began demanding higher yields. In a February 2025 auction of 30-year bonds, the yield came in 5 basis points above market expectations, a significant miss that indicated weak demand. The Treasury Department's own data showed that the bid-to-cover ratio, a measure of demand relative to supply, had fallen to 2.1, the lowest since 2009. A leaked Federal Reserve memo from January 2025 noted, liquidity conditions in funding markets have deteriorated more rapidly than model projections indicated, raising concerns about market functioning under stress scenarios. This was central bank code for, "We're worried the plumbing might seize." History was repeating in real time. The 2019 repo crisis required $400 billion in Fed intervention. The 2008 crisis began with funding market seizures. Bear Stearns and Lehman couldn't roll over short-term borrowing, triggering death spirals. In 1998, long-term capital management's collapse stemmed from a liquidity shock that conventional models said was impossible. Every major financial crisis begins the same way. Liquid markets suddenly aren't liquid anymore. In 2025, the trigger was obvious. Massive Treasury issuance colliding with reduced foreign demand and quantitative tightening. The Treasury needed to sell $2 trillion in new debt annually, while the Fed was removing $800 billion in liquidity through balance sheet runoff. The math didn't work. There weren't enough buyers at prevailing yields. Liquidity wasn't tightening, it was disappearing. The dollar index surged to 115 in January 2025, its highest level since 2002, as global investors fled to safety amid European recession fears and Chinese property market turmoil. But the strength was deceptive, a liquidity-driven spike, not a vote of confidence in American fundamentals. By April 2025, the reversal came violently. The dollar plunged 11% in a single quarter, the steepest decline since the 1985 Plaza Accord crisis, when coordinated central bank intervention deliberately crushed dollar strength. But this time, there was no coordination, just foreign creditors dumping treasuries and dollar reserves as debt sustainability concerns overwhelmed short-term safety considerations. China's treasury holdings fell to $760 billion, down from $1.3 trillion in 2013. The reduction was deliberate, systematic, and accelerating. Japan, despite its alliance with the United States, trimmed holdings for the fifth consecutive quarter. Even traditional dollar stalwarts showed hesitation. The European Central Bank reduced the dollar share of its reserves from 62% to 58%. The Gulf states, historically America's most reliable creditors, shifted $120 billion into gold and diversified currency baskets. The speed shocked currency traders. In the 1971 Nixon shock, foreign central banks had months to adjust to dollar instability. In the 1985 Plaza Accord, the transition was negotiated and managed. But in 2025, the capital flight was spontaneous, driven by mathematical recognition that U.S. debt was unpayable at current growth rates. Worse than the 1971 gold shock. Worse than the 1985 Plaza Accord volatility. Currency analysts published research showing that reserve currency transitions historically occur over decades. Sterling's decline took 30 years, from the 1920s to the 1950s. But the analysis missed a critical variable. Global interconnection accelerates everything. In 1950, international capital flows were 5% of global GDP. In 2025, they exceeded 25%. When faith breaks, capital moves at digital speed. The system was already cracking. The dollar's decline fed directly into import price inflation. Oil, priced in dollars globally, effectively became 11% more expensive for Americans. Consumer goods from Asia saw immediate price increases. Walmart and Target announced price hikes in April 2025, blaming currency weakness and transportation costs. Foreign demand evaporated when America needed it most. Europe entered recession in Q1 2025. Germany's manufacturing sector contracted for the eighth consecutive quarter, its longest downturn since reunification. France faced pension crisis protests that paralyzed major cities. Italy's debt-to-GDP ratio climbed past 150%, triggering ECB emergency bond purchases to prevent yield spikes. The Eurozone economy shrank 0.7%, with no recovery visible in forward indicators. China's property collapse accelerated beyond containment. Evergrande's default cascaded through the sector. Country Garden, Sunac, and Shermao all entered restructuring. Total property sector debt exceeded $5 trillion, with 40% in default or distressed. Ghost cities multiplied. Construction halted on 15 million pre-sold apartments, triggering mortgage boycotts and bank runs. The sector, which represented 28% of Chinese GDP, was imploding. Beijing's stimulus attempts, rate cuts, reserve requirement reductions, property purchase incentives, failed to restore confidence. Emerging markets faced currency death spirals. Turkey's lira collapsed 34% in Q1 2025 despite emergency rate hikes to 65%. Argentina defaulted for the 10th time, with inflation surging past 200%. Pakistan negotiated its 24th IMF bailout as foreign reserves dropped below $4 billion, less than 1 month of import coverage. Sri Lanka, still recovering from its 2022 default, faced renewed crisis as commodity prices surged. Global supply chains seized. Shipping disruptions, labor shortages, and credit freezes created bottlenecks worse than the pandemic peak. The Baltic Dry Index, measuring shipping costs, spiked 180%, while delivery times stretched to 2021 levels. Manufacturing orders collapsed as businesses couldn't finance inventory purchases at 8% interest rates. The contagion surpassed 2008. In that crisis, global trade fell 12% and recovered within 18 months. But 2025's crisis combined financial collapse with supply destruction and currency instability, a triple shock without modern precedent. The 1997 Asian financial crisis devastated regional economies, but didn't trigger European recession or Chinese property collapse. The 1929 depression spread globally but occurred in a less interconnected world. International trade was 10% of global GDP, then versus 60% in 2025. Worse than 2008. Worse than 1929. The numbers were worse than 1929. Every region was now exporting crisis. The 10-year Treasury yield breached 6% in May 2025, a level not seen since the 2000 dot-com peak. but the context made it exponentially more dangerous. In 2000, federal debt was $5.6 trillion, manageable at 6% rates. In 2025, $37 trillion in debt at 6% meant $2.2 trillion in annual interest costs, nearly equal to all federal tax revenue. Mortgage rates hit 9.2%, higher than any level since the early 1990s. Home sales collapsed. Existing home sales fell 38% year-over-year, worse than the 2008 crash's 31% decline. Housing prices, which had remained elevated through early 2025, began falling in major metros. San Francisco prices dropped 12% in 2 months. Austin fell 15%. Phoenix declined 18%. The corrections were accelerating faster than 2008's initial phase. Corporate refinancing became impossible. Companies with debt maturing in 2025 to 2027 faced a brutal reality. Their average borrowing cost from 2010 to 2021 was 3.2%, but refinancing now required 8 to 9% rates. The math didn't work. Cash flows that comfortably covered 3% interest couldn't handle 9%. Investment-grade companies faced downgrades to junk. Junk-rated companies faced bankruptcy. Small and regional banks choked on unrealized losses. The sector held $2.1 trillion in securities underwater due to rate increases since 2022. First Republic, Silicon Valley Bank, and Signature Bank's 2023 collapses had been contained through emergency measures, but May 2025 brought renewed stress. Deposit flight accelerated. Customers moved funds to money market funds offering 5% yields, leaving banks with negative net interest margins. This wasn't speculation. It was mathematics. Federal Reserve officials faced an impossible choice. Raising rates to combat inflation caused debt service costs to explode and pushed regional banks toward insolvency. Cutting rates risked reigniting inflation and triggering currency collapse. Holding rates steady guaranteed rising unemployment and corporate defaults. There was no winning move. Every option led to different forms of systemic failure. History was repeating in real time. High yields combined with high debt loads create mechanical collapse. The structure doesn't negotiate. The bond market was the detonator. Regional banks saw deposit flight at twice the speed of 2023's crisis. In March 2023, Silicon Valley Bank lost $42 billion in deposits in 2 days. But by June 2025, multiple regional banks were experiencing similar runs simultaneously. PacWest, Western Alliance, and Comerica all reported deposit declines exceeding 15% in a single month. The FDIC's Deposit Insurance Fund, containing $128 billion, was designed to cover isolated failures, not systemic flight. Commercial real estate losses drove the crisis deeper. Regional banks held $1.7 trillion in CRE loans, with 35% maturing by end of 2026. Property valuations had fallen 40% from peaks, but loans were still booked at original values. When banks were forced to mark-to-market, capital ratios would plunge below regulatory minimums. Office buildings in San Francisco traded at 55% discounts to 2019 prices. Manhattan Class B office space saw 30% vacancy rates with no recovery visible. Worse than the S&L crisis. Worse than 2008 regional bank failures. Funding stress spread through the financial system. The Federal Home Loan Banks, the so-called lender of next to last resort, saw borrowing surge to $1.3 trillion, higher than during the 2008 crisis. Banks were quietly accessing emergency liquidity to cover deposit outflows, a sign of severe stress invisible to most investors. Federal Reserve data showed unusual reserve concentration. 80% of reserves sat with the top 10 banks, while smaller institutions operated with minimal cushions. This meant large banks were hoarding liquidity in preparation for system stress, refusing to lend in overnight markets, and demanding higher risk premiums for any credit extension. The system was already cracking. When banks retreat from lending, credit vanishes and economies seize. In 2008, the credit freeze turned a financial crisis into the Great Recession. The first institutions were already failing silently. Derivatives exposure surpassed $320 trillion notional value globally, exceeding pre-2008 levels. The figure was largely meaningless, Notional values represented theoretical maximum exposure, not actual risk, but the growth revealed increasing reliance on leverage and hedging in a volatility regime. What mattered more was the composition. Corporate private credit reached $1.7 trillion in outstanding loans by mid-2025, double the 2018 level. These loans, extended by private equity funds, hedge funds, and specialty lenders, sat outside traditional banking regulation. Critically, 65% were priced at floating rates, meaning borrowing costs had tripled as interest rates rose from near zero to 5.5%. Companies that borrowed at SOFR plus 3% in 2021 now faced SOFR plus 3% with SOFR at 5.5%. Total interest costs of 8.5% instead of 3%. The leverage shock surpassed 2008's subprime crisis in speed and scale. Subprime mortgages totaled $1.3 trillion and took 3 years to collapse, 2005 to 2008. Corporate private credit was $1.7 trillion and began defaulting within 18 months of rate increases. The private equity firms that originated the loans had no obligation to hold them. They depackaged them into collateralized loan obligations, CLOs, and sold them to pension funds, insurance companies, and foreign banks. CLO issuance hit $175 billion in 2024, near record levels, creating the same diffusion of risk that magnified 2008's crisis. No single institution knew its total exposure. Hedge funds held CLO tranches as safe assets. European banks bought AAA-rated CLO slices. Japanese pension funds sought yield in BBB-rated tranches. When defaults accelerated, the losses would cascade unpredictably. The numbers were worse than 1929. Leverage isn't dangerous when rates are stable. Repricing leverage destroys capital structures overnight. Repricing turned risk into guaranteed collapse. A failed Treasury auction triggered the collapse. On June 12, 2025, the Treasury attempted to sell $32 billion in 10-year notes. Demand was catastrophic. The bid-to-cover ratio fell to 1.8, the lowest in modern history. Yields spiked 80 basis points intraday, from 5.9% to 6.7%, as primary dealers refused to absorb supply at prevailing prices. The failure was unprecedented. The U.S. Treasury had never failed to place debt since the modern auction system began in the 1970s. Even during the 2011 debt ceiling crisis, auctions cleared. Even in March 2020's COVID panic, buyers emerged. But in June 2025, foreign central banks were selling, domestic banks were capital constrained, and institutional investors demanded higher yields to compensate for fiscal risk. Money markets froze within hours. The repo market seized. Overnight rates spiked from 5.3% to 8.7% as lenders refused to roll over positions. Commercial paper markets shut down. Corporate treasurers couldn't access short-term funding. The financial system's circulatory system stopped. Margin calls exploded across markets. Hedge funds using Treasury securities as collateral faced forced liquidations as bond values plummeted. Stock index futures triggered circuit breakers as algorithmic traders exited risk positions. The VIX Volatility Index surged from 18 to 67 in a single session, the fastest spike since March 2020. Worse than the 2020 crash. Worse than the 2008 panic. This wasn't speculation. It was mathematics. Every financial crisis contains a trigger moment, a specific event that breaks confidence and starts the cascade. In 1929, it was Black Thursday's panic selling. In 2008, it was Lehman's bankruptcy. In 2025, it was the first failed Treasury auction in modern American history. The auction failure removed all doubt. Forced selling cascaded through every asset class. Mutual funds faced redemptions exceeding 8% of assets in a single week, worse than any week in 2008. Exchange-traded funds broke from their net asset values. The SPDR S&P 500 ETF traded at a 4% discount to underlying holdings as market makers refused to arbitrage the gap. Bond ETFs saw 12% discounts, liquidity evaporated, and panic spread. Real estate imploded faster than 2008. Home prices fell 23% in 3 months across major metros, a pace that took 18 months during the housing crisis. Commercial property auctions saw zero bids. REITs collapsed. Office REITs fell 68%, retail REITs dropped 54%, multifamily declined 41%. The structures that held $4 trillion in property equity vaporized. Banks collapsed in sequence. First were the regional banks with heavy CRE exposure. PacWest, Western Alliance, Zions Bank Corporation all entered FDIC receivership within 2 weeks. Then came the mid-tier banks with securities losses and deposit flight. Comerica, KeyCorp, Fifth Third. By July 2025, 47 FDIC-insured institutions had failed, overwhelming the Deposit Insurance Fund. The Federal Reserve launched emergency programs overnight. The Bank Term Funding Program was expanded to unlimited size. Discount window borrowing hit $2.8 trillion. The Fed began purchasing treasuries at $120 billion per week, more aggressive than 2020's peak. Interest rates were cut 100 basis points in an emergency weekend meeting. But the intervention backfired. Inflation surged as dollar weakness accelerated and import costs spiked. The Fed's choice, save the financial system or save the currency, resulted in choosing the financial system. The dollar fell another 8% in July alone. Oil hit $135 per barrel. Food prices jumped 4% month over month. Savings evaporated. Stock portfolios fell 47%. Bond portfolios dropped 31%. Real estate equity vanished. Retirement accounts lost $8 trillion in value. Worse than 1973. Worse than 2008. History was repeating in real time. The spiral had become self-feeding. With $37 trillion in debt unpayable at 6% yields and the dollar destabilizing from foreign capital flight, the solution arrived not as policy announcement, but as infrastructure deployment. Tokenized treasuries appeared in March 2025, blockchain-based securities that settled instantly, bypassed traditional dealers, and attracted global crypto liquidity. Within months, $400 billion in treasuries were tokenized, creating a parallel market that functioned when traditional markets froze. The technology allowed fractional ownership, 24/7 trading, and settlement in minutes instead of days. Digital dollar infrastructure deployed simultaneously. The Federal Reserve's FedNow system expanded to include central bank digital currency capabilities. By August 2025, 40% of Americans held digital dollar wallets. The infrastructure enabled something critical: programmable money. The government could issue stimulus directly, track spending in real time, and most importantly, gradually devalue currency through controlled inflation without triggering panic. Gold-backed settlement rails emerged through international agreements. The BRICS nations, Brazil, Russia, India, China, South Africa, launched a gold reference trade settlement system in April 2025. Rather than fighting it, the U.S. Treasury quietly began accumulating gold reserves, increasing holdings by 15% through undisclosed purchases. The move signaled a return to partial commodity backing, not a formal gold standard, but a hybrid system where debt could be collateralized against tangible assets. Silent inflation became policy. The Fed maintained nominal rates at 4%, while actual inflation ran at 7 to 9%, creating negative real rates that eroded debt burdens automatically. In real terms, $37 trillion in debt would decline to $32 trillion in purchasing power within 5 years. Bondholders suffered, savers lost, but the government's balance sheet stabilized. This was worse than Nixon's 1971 gold shock, which at least was announced. Worse than any previous monetary reset because it occurred through technical infrastructure deployment that the public neither understood nor consented to. The system was already cracking. The U.S. wouldn't default loudly. It would default through crypto monetization and gold collateralization without anyone noticing until their savings had lost 40% of purchasing power. The reset had begun long before the public understood it. At 124% debt to GDP and accelerating toward 140%, the outcome wasn't political. It wasn't theoretical. It was mathematical. Every economy that crossed 130% without currency sovereignty, trade surpluses, or captive creditor bases experienced default, hyperinflation, or forced restructuring. The U.S. had none of those protections. Foreign creditors were fleeing, trade deficits exceeded $1 trillion annually, and the Fed couldn't print its way out without destroying the dollar's reserve status. The pattern had repeated exactly. Rising valuations masking debt accumulation, insider selling preceding retail panic, liquidity stress cascading into funding crises, yield spikes destroying refinancing capacity, currency flight accelerating inflation, and finally monetary reset disguised as technological innovation. The mathematics had been visible for years. The outcome had been certain the moment debt service exceeded defense spending. The collapse had been guaranteed when debt began compounding faster than GDP growth. History had shown the path: 1929, 1971, 2008, and 2025 followed the script precisely, only faster and with higher debt loads that made recovery impossible without currency destruction. The system hadn't approached failure. It had already failed. The interventions weren't solutions. They were mechanisms to distribute the losses through inflation, financial repression, and silent wealth confiscation. The cryptocurrency adoption, digital currency rollout, and gold accumulation weren't innovations. They were the architecture of default disguised as progress. At 124% debt to GDP, the ratio that destroyed Greece, destabilized Italy, and marked Japan's permanent stagnation, the United States crossed the mathematical point of no return.